I've been getting a lot of calls saying, I heard the Fed lowered the rates. What can we do for my refinance? And I'm anxious to help you refinance, but I want to explain the Fed funds rate. It's not a long-term rate. It's literally the overnight rate. It's the rate for banks loaning money to each other overnight, but it is the building block for most interest rates. So when the Fed lowers the short-term rate, it almost immediately impacts credit card debt, money market, what the money market's paying, car loans, home equity lines, things like that. But long-term rates, like mortgage rates, are impacted more indirectly. An example of this happens as the Fed cuts rates and investors' return on the money market funds decrease. And it's anticipated the Fed will continue to lower rates, which will continue to lower the return on money markets. So investors will want to keep their money coming in. So they'll start investing in other things like the 10-year treasury. And as the 10-year treasuries are purchased, their prices tend to improve, which lowers the yield. And mortgage rates typically follow the direction of the 10-year treasuries. Recently, in anticipation of the Fed lowering the short-term rate a half a point, which almost everybody knew was going to happen, the 10-year treasury and mortgage rates already had that factored in. They'd already gone down. And then right after the Fed did that, a real strong jobs report came out, which surprised the markets and makes them worried about inflation. So actually, mortgage interest rates went up a little bit. But we anticipate the Fed's going to continue to lower the short-term rate, and eventually that'll work to us in mortgage rates. Have a great day.